Hello, I'm Fenton Burgin, a partner in Deloitte's debt advisory business. I wanted to touch on three key things that are going to impact the debt markets for the rest of 2012. Firstly, the increased pricing and lack of bank liquidity. Secondly, the big gap that's opening up between those companies that have got access to the capital markets and those that don't. And then thirdly, just touch on the big structural issues that still remain in the leveraged finance space. In the face of over $3 trillion of support from the Fed and €1 trillion of ECB-backed support, many companies are saying to us, why is corporate debt remaining so highly priced and why is it so scarce? In the UK, the answer is firmly based around the exposures that the major UK banks have to the Eurozone, and that's impacting their own cost of funds. Post the LIBOR scandal, many commentators have focused on bank credit default swap spreads as being a truer reflection of banks' own cost of capital. If you look at CDS spreads today, notwithstanding the recent action by the ECB, you're still at close to all-time highs. If we overlay on that the cost of investment-grade debt and then look at leverage loan pricing as well, the correlation's really clear. And for those reasons, we don't see the cost of corporate debt reducing over the next 6 months. We're seeing a really big gap open up between those companies that have got access to the capital markets and those that haven't. The net effect of the ECB and Fed support packages has been to depress Treasury and gilt yields to historic lows, and we're seeing companies rush to refinance bank debt in the bond markets as a result. In the last quarter alone, we've seen over $260 billion of issuance at a below 4% yield. That's a record level of issuance over the last 17 years and the lowest ever average yield. In the high yield market, we're seeing exactly the same dynamic. You've seen in August alone $27 billion of issuance. That compares to an average monthly issuance for the whole rest of the year of $7 billion. So we are seeing here a big structural change away from the bank markets to the bond markets. Historically, European companies have utilised bank debt to a much greater extent than in the US, and we see that trend continuing for the rest of 2012. So what are UK corporates doing in response to this capital markets activity? Well, the answer is preserving cash, preserving liquidity buffers, adopting relatively conservative strategies towards the Eurozone crisis. The Association of Finance Professionals recently estimated that UK PLC's got over 750 billion of cash sitting on its balance sheet at the moment. That's a record high. It's double where we were 10 years ago, and it's roughly half total UK GDP. Finally, there are some big structural issues sitting out there in the leveraged finance market. Over the last 12 months, you've seen a lot of amend and extend activity, but we still have over 100 billion euros of debt set to mature over the next 2 years, and its underlying credit quality is getting worse. That's going to have a big drag effect on the market over the next 12 to 18 months.
Fenton's talked about a lot of big themes out there in capital markets, and what I want to do is just pick up on some of those themes as they've been reflected in our latest survey of chief financial officers. Now, the CFO survey is a survey of big companies. What we've seen in the latest survey for September is a decent recovery in business optimism and in risk appetite after record declines in business optimism back in June. That reflects the fact that central banks are printing money again. The European Central Bank has come up with a new initiative to try to bind together the single currency. So we've seen a bit more optimism, but that's really tempered in this survey by the fact that corporates see an awful lot of risk out there. They've told us that the biggest single factor depressing their capital spending plans is economic uncertainty. They see really quite a high risk that the euro area will break up over the next 12 months, that the UK's recession will either run on well into next year or will recur. Corporates are really quite focused on defensive balance sheet strategies. What we've found is that the commitment to cost reduction and harbouring cash is higher now than it has been at any time in the last couple of years. Credit conditions are getting better. They've been getting better for the last couple of years. In this survey, CFOs tell us that their perception is that the cost of credit is at its lowest level in 5 years. Credit availability is pretty good, and there's tremendous enthusiasm amongst these very large companies for issuing corporate bonds. One of the things that comes through when we have these discussions with officials is that actually what we're seeing for big companies doesn't reflect the experience of an awful lot of mid-market and smaller companies out there in the market. So I guess we're in a world of slightly higher optimism, where there's perceived to be a lot of risk, a lot of uncertainty out there, where companies are focusing on building up cash, reducing costs. I think the challenge for them is to both manage the economic risks out there, and they're certainly very aware of those economic and financial risks, but at the same time make use of what appear to be pretty strong balance sheets to find new sources of revenue and new sources of growth in what seems almost uniformly to be seen a very uncertain world.